All right, listen up because your pal Kramer is here to make you some money in the gold market. Forget the fancy charts and the Wall Street mumbo-jumbo. We're talking about simple, powerful plays for ZAUSD. That's the ticker for gold, folks. For next week, August 18th to the 22nd, 2025, the story is all about one thing: cautious optimism. I see gold coiling up like a spring, getting ready for a move. The bears had their fun, they tried to push it down, but the bulls are showing some serious backbone. Let's talk about one of my favorite tools in the shed, the Simple Moving Average, or SMA. Don't let the name fool you. It's simple, but it's powerful. Think of it as the market's pulse. We use two of them, a fast one and a slow one. For our purposes, let's use the 10-day SMA, the speedy hare, and the 30-day SMA, the steady tortoise. When the fast line crosses above the slow line, it's a golden cross. That's a buy signal, folks. It's a green light telling you the bulls are taking charge of the field. It's a beautiful, beautiful thing. Conversely, when that zippy 10-day line crosses below the slow and steady 30-day line, that's a death cross. Yikes! It sounds scary and it should be a warning. That's your signal that the trend might be turning sour. Next up is another one of my go-to indicators. It's called the Relative Strength Index, or RSI. This little beauty is your market thermometer. It tells you if gold is running too hot or getting too cold. The RSI moves between 0 and 100. Here's the simple rule. Anything above 70 means the asset is overbought. Think of it like a stock that has run up too far too fast. It's probably due for a breather, a little pullback. On the flip side, when the RSI dips below 30, that means gold is oversold. The sellers have gotten carried away. This is where the bargain hunters, the savvy investors like you, start sniffing around for an entry point. Right now, as we head into the week of August 18th, gold's RSI is hovering right around the 55 mark. It's in neutral territory. It means we have plenty of fuel in the tank for a move higher without immediately becoming overbought. This last strategy is the bedrock of technical analysis. Think of it like a multi-story building. The price of gold is an elevator. The floor below is support, a price level where buyers tend to step in and support the price, preventing it from falling further. The ceiling above is resistance, a price level where sellers tend to emerge, putting a cap on the price and resisting its move higher. Your job is to know where the floors and ceilings are. That's where the big money decisions are made. For next week, the lines in the sand are crystal clear. We have a major resistance ceiling at $2,050. On the downside, we have a solid support floor around $2,010. Your game plan is to watch these two zones like a hawk. A decisive high-volume break above 2,050 is a massive buy signal. The battle for next week will be fought and won at these two key price points. Let's look at the tape from last week, August 11th to the 15th, because the past gives us clues for the future. What did we see? We saw a market in consolidation, a tug of war. The week opened with some nervousness, and the price dipped down toward that critical $2,010 support level I told you about. But what happened? The buyers showed up. They defended that level like it was the Alamo. The rest of the week was a story of sideways chop. The price traded in a relatively tight range, mostly between 2020 and 2035. This is what we call building a base. Think of it like an army gathering its forces before a major assault. The RSI spent most of the week drifting in that neutral 50 to 60 zone, confirming the lack of strong directional momentum. Our moving averages, the 10-day and 30-day, started to converge and move sideways, practically on top of each other. Buy. So what's the game plan? Here's Kramer's playbook for August 18th to the 22nd. I am cautiously bullish. My primary scenario is that gold will make another attempt to break through the $2,050 resistance level. I'm not saying to mortgage your house and go all in on Monday morning. No, we wait for confirmation. The plan is to watch for a daily candle to close decisively above 2,050. I'm talking a solid green candle, preferably with strong volume. Once we get that breakout above 2,050, that's when you can consider initiating a long position, a buy. Your initial target should be the next area of resistance, which I see up around the 2,075 to 2,080 zone. And where do you put your stop loss? You place it just below the breakout level, maybe around 2,040. This is crucial. It's your safety net. Trading without a stop loss is like driving a race car without a seatbelt. It's just plain dumb. Don't do it, ever. Now what if I'm wrong? What if the bears come out of hibernation and take control? We need a plan for that, too. If, instead of breaking higher, gold breaks down below that solid floor at 2010, then the bullish thesis is off the table for now. So to recap the action plan, be patient at the start of the week. Watch the key levels of 2050 and 2010. Follow the plan, stick to your discipline, and you'll be ahead of 90% of the traders out there. It's that simple. For all you new traders out there, listen to Uncle Kramer. Start small. Learn the ropes. Don't risk money you can't afford to lose. Paper trade these strategies first if you have to. Build your confidence. Understand how these indicators work in a live market. The setup is there for a potentially profitable week in gold. The bears had their shot and they missed. Now it's the bulls' turn to take the field. There's a bull market somewhere, and next week I think it might be in that shiny yellow metal. Don't get mad, get educated. And then get gold. Boo-yah!